Hey, how's it going? In today's video, I'm going to be telling you on how you can build your credits. Now, I come across this a lot where I'm talking to a client and they're not too familiar with how your credit score is determined. So in today's video, to make it very simple, I'm going to be going over a few things. First of all, I'm going to be going over on how is your credit score determined in the first place, who determines your credit score, what's the easiest way for you to start building your credit, and then finally, what is the right way to go ahead and use your credit so that you can build up your credit score. First of all, this entire process is super complicated and you can go online, you're going to be able to find a whole bunch of things at certain percentage this, certain percentage that, blah, blah, blah. Forget that. First of all, who determines your credit score? So right now in the United States, we have 3 credit bureaus that basically calculates what they believe is your credit score. So first of all, what we're going to go ahead and do is we're going to name the 3 of them. The first one we have here is TransUnion. The second one we have here is Experian. And then the third one we have here is Equifax. The best way that I like to explain this is they're basically an entity that collects all of your credit information and they basically provide a credit score based off of this credit information. Now, what type of information is shared or sent to these credit bureaus? Whenever you have a line of credits or a credit card, credit account, or anything in regards to credit, they get this information. So the first thing that they get is the age of your credits. The second thing they get is how many times are you checking your credit, or other words, inquiries. And for the third thing they check for is how much of your credit are you using? And then finally, they also determine what is your payment history for your credit account. People who have a credit card, student loan, personal loan, or any type of loan, mortgage or whatever, they're going to be having all of these 4 different items. So if we talk about a mortgage, you're going to be having a payment history, credit usage, that's usually the loan amount that you have on the account. How many times did you check your credit to go ahead and get that loan application? And then finally, how long has this account been in good standing? Whenever you have a credit account, or if you don't have a credit account, whatever account that you have with that's attached to your social and your name and your date of birth and where you currently live, you're going to be getting a particular credit score. Now, if you don't have any accounts, any type of credit, what ends up happening is your credit score is 0, which is perfect because that's easier to start working with. What ends up happening is, let's just say you have a credit card and you missed a few of your payments. That's going to tank your credit score because typically this is how your credit score works. Your credit score is determined by a compilation of all these 4 different things. There's different percentages for each of them. I'm not going to give you a particular percentage. All you do need to know is which ones are the most important. Now, the 2 most important things that drastically influence your credit score is these 2 items. You're going to be talking about your credit usage and also your payment history. Now, which one is the most important between the 2 of them? Well, in a way, it kind of depends because look, you can have a high credit usage, but as long as you're making your payments on time, your credit score is still going to be decent. However, once you mess up in terms of a payment history, then at that point, that's when it kind of sticks to your credit profile. So if you're going to be focusing on anything as much as possible, I would suggest for you to focus on making sure that you make the payments on time every month. To go ahead and move forward with this video, I'm actually going to be telling you what is the easiest way for you to start building your credit, or maybe even start fixing your credit. And that is actually going to be using a secured credit card. Why is a secured credit card a good idea? So typically when you have a credit card, the bank basically says, hey, look, you know what? We're going to give you $100 for this credit limit and you can use this as you please. The main difference here between a secured credit card and an unsecured credit card is the bank is going to be asking you for money up front for the credit limit. So if you want to get a secured credit card of $100, the bank is going to ask you for $100 in return for collateral. Basically, what ends up happening is you start paying interest on the money that you give the bank. I know it's a little bit convoluted. However, if you're trying to build your credit score or fix your credit score, this is actually one of the best ways to do it because this actually gives you opportunity to start working on your credits, especially if you've had no experience or poor experience with your credit history. For a credit card, you're going to be getting a certain annual percentage interest rate. For the case of this example, we're going to be going ahead just using a 24% interest rate. Now, what does that do? You pay interest on the money that you owe on your credit card. So APR is an acronym for annual percentage rate. And what ends up happening is every month you're going to be paying a certain types of monthly interest. Typically what ends up happening is this. You get your APR and you divide that by 12. So if you get 24 divided by 12, that's going to be 2% in terms of monthly interest. And then the next important thing is you are only going to be paying interest on the money that you are borrowing. Let's just say we go ahead and you're like, okay, cool. I'm going to go ahead and start working on my credit. So for this first month where we go ahead and start using our credit card, let's just say we just didn't use it at all. So our balance is actually going to be $0. So right here we have a $0 balance. Well, what does this provide us in terms of the 4 things that determine our credit? First of all, let's go ahead and say when we first got a credit card, we got 1 inquiry, age of credit. Great, it's just 1 month years old. Credit usage, there's no credit usage because you still have $100 to use. And payment history, if you have a credit limit of $100 and you don't owe anything to the bank, great. That credit card is actually useless. And here's the most important thing when it comes to having a credit card. If you want to start establishing your credit, you need to owe money to that card so that you can make a payment history. Now, what does that mean? So I have a lot of clients where they'll mess up, they'll get a secured credit card, and then the first month that they have the card, they don't use any money. So what ends up happening is this. You get a secured credit card to start building credit history. However, if you don't use a credit card, there's no payment history to start building. First of all, you're not using your credits. And second of all, you don't even have a payment history. So that credit card is basically just useless because you're not even using it. And how does this typically happen? Usually what ends up happening is, let's just say we have someone here and they go ahead and use a credit card and they only use, let's just say $50. But where people make a mistake in is that they go ahead and pay off this $50 balance because what we want to show the bank that we can have a balance on the card and we can make the payment from the card. Because what ends up happening is on that second month, we are supposed to be getting a monthly statement. And on this monthly statement, we're going to be getting told how much do we owe, how much is our balance, and what is the minimum payment on that balance. You need to make sure that you get this monthly statement that shows the minimum payment that you need to have on the account. What a lot of people make a mistake in is that they'll go ahead and then they'll just say, oh, you know what? We don't have a balance. We paid the card already. We used the $50 and we paid the $50 all within that same time period. Nope, that is actually just wasting your time. What you need to do is you need to go to the gas station, use $5, buy a Kit Kat, Twix, or whatever, doesn't matter. And you basically let that balance stay there until you get your monthly statements the following month. Ideally, what we want to have is a small balance where we owe $5 so that when we go into our next monthly statement, we have minimum payments of let's just say $5. The minimum payment changes depending on the bank. Usually with an account this small, they'll just have you pay the $5. Here, when we get this statement on the second month, we want to see that, all right, cool. We owe $5. The minimum payment is going to be $5. You make this payment, and then by the following month, you should have a credit history, right? Because you want to show that you have a payment history, and then you also want to show that you're using your credit. If you go ahead and pay off this $100 balance, you're not establishing any credit. So the only real way a credit card can hurt you are these 2 ways. First of all, if you don't make your minimum payment on time. And then the second way this can hurt you is that if this balance is too high. Now, ideally, if you want to get the best credit score possible, you want to be working anywhere between that 0 to 10% range. So for a $100 balance, you want to use anywhere between 1 cent up to $10. If it's a $500 card, 1 cent up to $50. Like I said, you want to make sure you use that 0 to 10% and leave that balance there for the following month so that you can make that payment. Now, how can you establish your credit the wrong way? Let's just say you still make the payment history. Your credit score actually gets worse the higher percentage you use your account. Usage goes up, credit goes down. And this is vice versa. If usage goes down, credit goes up. Now, here's the biggest takeaway from this. In between the months, between month 1 and also month 2, you can use as much money on that account that you want. It doesn't matter. The most important thing is by the time you get this statement, you need to make sure that you still have a balance between 0 to 10%. Just say day 1, I get the credit card. I have a $100 credit card. Perfect. I use $100 of it. My credit usage on paper is 100%. However, let's just say by next month, I actually pay down $90 on that credit card and I only have a balance of $10 by the time I get my monthly statement. My credit score is still going to be really high. And that's where people make the mistake. They start owing a lot more money than they should be. So instead of owing 0 to 10%, they actually owe way too much money, and that's how they end up hurting their credit. If we were to go ahead and summarize everything, is you want to go ahead and start up a secure credit card, come in $100, pay the bank $100 to give you a line of credit for $100. Go to the gas station, you buy Twix, candy bar, doesn't matter, or energy drink. And then you need to wait a whole month until you get your statement saying in terms of what is your minimum payment. You make that payment and then you go ahead and you go to the gas station and you use another $5 or whatever so that you can always, first of all, show that you have a credit usage and also show that you have a payment history. Get that minimum payments, you make that minimum payments, and you don't owe too much on your credit card. And just by doing that, you can get a ridiculously high credit score. Even if it's just one account, I've seen people that have no credits and they'll skyrocket up to like a 700 plus credit score. And that is actually one of the easiest ways for you to start building your credits. Now, how can you fix your credit if your credit score is already kind of tanked? Let's just say this is not a secured card, but let's just say we have a lot of cards, right? We have 3 cards. So in total, we have 3 credit cards and there's $300 in total. Now, the last thing you want to do is you don't want to max out all these cards. What you want to do is you want to slowly start going ahead and paying down these balances so that you can get the credit usage anywhere between 0 to 30%. And you'll be perfect in terms of being able to start working on your credit. Other real thing that you can control is your payment history. So when you have a payment history, if you paid late once, get caught back up to date with what the bank is requesting, start making the payments on time, start reducing your balance, and that will be one of the easiest ways for you to start working on your credit. Now, let's just say that you need a little bit more work in terms of fixing your credits. At least at this point, you have an idea on how your credit score is determined. Either way, you can also still try to see if you can get a secure credit card. And then at least at that point, you'll have one account that has a good payment history and a low usage. At that point, you're really just taking advantage of having one account that has a good positive payment history. That is all for today's video. I made this video because there's a lot of people who are more or less a little bit confused on like what's a good way to start building your credits. And that's pretty much it. You just do what I said to do here. If you don't have any credits, you'd be surprised on how fast it would be to get your credit score up. In the future, I'm going to be talking about a little bit more nuanced, detailed things. But other than that, like, subscribe, and stay tuned because I have a lot more in terms of being able to fix your credit or different things you can do to help fix your credit for buying a house or just boosting your credit altogether. So thank you very much and have a great day.